sent a question earlier. Lance had a couple of basic questions, but they don't exactly have basic answers. The first one is from Lance. I'd like to see some options for the married puts, the radioactive trades, which have less capital requirements. And what parameters make good candidates? How can the PowerOptions tools help in the search? Okay, fantastic. So let's go ahead and break that down one by one. First, what is a radioactive trade? Well, it's the married put structure that we prefer, and it follows the three basic rules of really all options investing. Proper position sizing, which is sometimes referred to as FIST, forcing an ideal size trade. It forces us to control risk and to avoid gambler's ruin, where, if you take a 5% loss on a position, you only need a 5.3% gain to get back to break even. And if I take a 10% loss on a position, I need an 11% gain. But if I take a 25% loss, I need a 33% gain to get back to break even. And if we take a 33% loss, we need a 50% gain on what we have left just to get back to break even. The at-the-money bell curve. Well, what this simply shows us, of course, is the curve of the position. I'm going to get a different pen color. That's okay. When you look at an option chain, the options that are at the money will always have the highest time premium at that time, up here. Options that are out of the money or in the money, depending if you're looking calls and puts, well, the out of the monies are going to be lower, and they're all time premium, and it's a lower time value. In the monies are mostly intrinsic, and will also have a lower time value. So we want to buy in the lower range and sell in the higher range. And that's why we're using the in the money put to keep the single digits and forcing an ideal size trade risk. The out of the money gives you double digits. And then, of course, the time value curve, the time value decay, the three core principles, that options that are 150, 120 days out in time have a much slower time decay than options that are 30, 20, 15 days out in time. So we want to be selling here, and whenever you're buying for speculation, for growth, or for insurance, you want to be out here in the $150, $200 range, so you get a much slower time decay, even if the stock is stagnant and not moving in price. So that's the basic structure. I'd look to buy a stock, buy a 5 to 6 month out put option against it to keep risk to single digits, using that in the money option, and then we'll apply things going forward. But it's dependent on owning stock to get the single digit risk to satisfy point number one, forcing an ideal size trade. Okay, so from today, from this afternoon, Ally Investment, one of the ones that came up on the married put search. I buy 100 shares of Ally, let's say, at $32.57. At the same time, following what I'd like to see in a radioactive trade, I'm going to buy the March 35 strike put for $3.90. This does make my total investment about $36.50. This $36.47 prices were changing. I'm going to call it $36.50. And so the maximum risk with a guaranteed exit at 35 is only 150, or 4.1%, or 147 and 4% here, and we have infinite upside profit potential. Forces the three caveats, the three core principles I just mentioned. Forced into ideal size trade with control risk, not over trading because of the monetary requirement, buying an in the money put following the ATM bell curve, and when I sell premium, it's going to be at the money, and I'm going out to March, which I think was 190 days out in time, so I'm following that red line, that time decay curve as well. Now, low-cost alternative number one, Lance, what some would call the parity trade. Just buy the out-of-the-money long call. It's the same cost, same risk, and you have the same risk-reward profile. Is the profit and loss chart the same or very similar? Yes. I would never say it isn't. The graph is exactly the same. The stock falls, we lose $150 at expiration. If the stock moves up, we make infinite profit, or we can make infinite profit in that case. Bullish strategy, same as the married put. Stocks at 35 or below, that's the max loss. Above the break even in this case, all the way at expiration to March. At 36.50, we have a profit and then beyond. What's different here is this, and this is the danger. Although the risk-reward profile, the profit and loss is similar, from a trading standpoint, the long call risks 100% of what you invest into the position. I'm using larger capital to only risk 4%. And the argument is always, I think a year ago it was, there was a lady commenting on one of the webinars who was saying, I don't understand this, you're teaching people the wrong things. You would make so much more money just buying the call, it's a better use of your money. Well, okay, let's talk about that, and let's talk about this low-cost alternative. Is it a parity trade? Not quite. Lance, you and I have a similar size account. Let's say we both have $4,000 we want to allocate today to buy a new position. I'm going to jump into a married put. I'm going to buy 100 shares of Ally and one put out to March. I'm going to put up about $3,650. I'm going to leave $350 aside. I have $150 at risk of that investment, or 4.1%, which might equate to only 0.5, 0.8, or 1% of my total portfolio. Now with the long call, you can afford to buy 26 contracts of that $1.50 same strike, 35 strike March call. You'd have $3,900 invested, which means you're risking $3,900, or 100% of what you invest. That doesn't look like the same trade at all, does it? Think about what happened a couple Wednesdays ago when the Dow dropped 600 points. What would my loss be compared to what your loss would be? That's not a fair comparison, and I know it. I always use that, though, to get attention. I know you wouldn't do that. You wouldn't put the full $4,000 into one position because you're attempting to use leverage to maybe diversify more and to try to get higher percentage returns. But looking at the $4,000 you have, what if you bought 2 contracts of Ally for $300? You're risking 100%. Are you going to leave the remainder, even if you bought 1 contract for the $150, are you going to leave the remainder of that $3,700 or that $3,850 aside and not trade with it? No. You're going to buy 4 contracts of XYZ for a total cost of $500. You're going to buy 3 contracts on ABC for $750. You're going to use that capital for other positions. So now, are you better protected on the long call because you're diversified into 3, 4, 5, 6 positions instead of just 1? Well, potentially. Better protected, not necessarily, but you might see more profits as well. Okay, now, that's what I mean, set for better profits there. Sorry, I'm just scrolling down here as well. Okay, now, okay, sorry, something I'm doing isn't working. That's okay. So are you set for better profits on 3 positions? Perhaps in the right market, but you also have 10 times the exposure, and what we're seeing is a headline-driven market. Okay, what do I mean by that? Well, you've got 750 at risk on ABC, 500 on XYZ, that's 1250. So you're at $1,550 total risk on these long call positions, $1,550 exposed into what we've seen with these shifts whenever there's a new headline that comes out. A couple Wednesdays ago, Dow is down 600 points and so forth. I'm still only risking 150, not 1,500. Okay, so that's what we look for there. Now, I'm not going to go in depth here into the comparisons, other comparisons, the long call versus the married put. It's an alternative that comes to mind, but it's not specifically a parity trade at all. Check out the full presentation here, the YouTube, u2.be/S, capital O, capital S, capital O, little p, 5, EMB, _D, capital Q, and 0. Or you can search on the PowerOptions YouTube channel for 3 core principles in trade comparison. I talk about the RPM versus the long call, the radioactive trade versus selling a near-term put and buying the same put that you would in the married put, a calendar put spread. The idea being if the stock falls, I get put the stock at a lower price. I get assigned on the short put, and I already have the long put to protect it. Well, that's great and everything, but keep in mind, oh, I don't want to do it there. Keep in mind that the calendar put spread is a profit and loss chart like this. So although you might get in at a lower cost because of the premium and the potentially lower strike of the put that you sold, you now have almost two ways to lose depending on the structure, and it's a capped gain in the direction you thought the stock was going to go. Now, we also compare in that webinar the radioactive trade versus an in-the-money long strangle. Instead of buying the stock, buy an in-the-money long call and buy that in-the-money put that you would buy for the married put. Most of the problem there, of course, is that you need a larger move on the upside to see a profit on that strangle than you do in the married put, and I show 2 or 3 examples of that occurring in real market conditions in that webinar. 3 core principles in trade comparison. You can search for that on the PowerOptions YouTube channel. That'll give you more insight. One thing that's missing, and one of the alternatives we've talked about in the past couple of weeks during these webinars, that is also a low-cost alternative, sorry folks, is the synthetic married put, a true sort of synthetic married put, as opposed to saying that the long call is a synthetic married put, or that the married put's a synthetic long call. In this example, I'm going to buy the same March 35 put I would have in the married put, but instead of buying the stock, I'm going to sell a March at slightly out of the money put, same expiration. I'm going to sell the 32 put for $228. At the same time, I'm buying same strike, same expiration, call. Short put plus long call, same expiration, same strike, equals synthetic long stock position. This one happens to be done at a debit. Sometimes you might be able to get a credit, which would lower the cost of the long put and might give you lower the risk. But it's also looking at the intrinsic value as well. See, this 32 call at 288 is 50 cents, 58 cents in the money. So the time value cost is 230, almost equal to the time value cost you're getting for that 32 strike put. So the risk is still about the same, 150 monetarily. And it's 33.3%. Well, how can the same monetary risk be 33.3%? And it's because you also have to put up a monetary requirement in this case in addition to the debit. You've got to cover the $3 difference in strike prices from your 35 put to your 32 put in a sense. So there's a margin requirement there as well as the initial cost. So you end up with a 33.3% risk. Again, is the profit and loss chart, the risk-reward profile, the same? Yes. Is the monetary amount at risk the same? Yes. The risk is gambler's ruin and over trading because you're using leverage. You trade too much, this can go up to 450, 550, 650 at risk, whatever have you, how many contracts you choose to do, whereas I'm still forced into any deal size trade. You could do, with the monetary requirement at 450, you could do maybe 9 contracts. Well, where would that put you as a monetary risk? Okay, so let's say you only did 3 contracts. Okay, now you're at a $450 risk. So that's the danger there of doing it. You have to be disciplined. The pros and cons of the synthetic married put position. Lower cost, which is what you asked about. Can you still do the income methods? Yes, but you're going to probably need to be at least on level 3 trading. Why do I say that? Because you don't own the stock. You own a long call that's out in time. So selling a call against it might be a debit spread or a credit spread depending on the structure. Okay, so you could still do the income methods, but you're going to have to be able to do spread trades. Some of the more advanced income methods, income method number 6 and income method number 5, you may actually end up holding a naked call because of the obligations, because you don't own the underlying stock. Is the monetary reward and the risk reduction monetarily similar? Yes, if you're approved to do them, because you're not doing them against stock, you're doing it against a long call. And likely to do the synthetic stock position anyway, you'd have to be at that higher level of trading, so it's a moot point, unless you're saying, hey, I only got level 1 trading, maybe even level 2 trading, can I do the synthetic? And the answer might be no. And if you could do the synthetic on level 2, using a cash secured naked put, but technically you're in a spread, right, because you own that other put as well, but now you're in that position where you're looking at it and doing the income methods. You might not be able to do as many because of the level of trading that you're approved for. The cons of the synthetic, well, you're taking a 33% higher risk, same danger as the long call, gambler's ruin. One thing that's misunderstood about the synthetic is that you may end up having to buy shares of stock if you want to, but it might be out of your control. So the stock falls, an unexpected event, pre-earnings early warning announcement. Yes, you sold the put that's far out in time, and yes, you own the long one. But if it's between the strikes, or you're at a position where you get assigned on the short, your broker may or may not exercise the long put immediately to close out the position. You may end up being short shares of stock. You may end up buying the shares of stock for the obligation of the short put. Now you have a long stock, a long call, but the long stock's still covered with the married put that you still own because your broker didn't exercise it right away. It's a little different structure, and now if the stock falls, you can lose on that married put position, which you may have gotten at a cheaper price. You got the stock at a cheaper price because you sold the put there at 32 instead of buying it outright. But again, now you have a long call and a married put, so if the stock continues down, you're losing on what you had left on the long call and on the married put position. Kind of tricky. But again, doing the income methods may result in extra margin. So from a few weeks ago, again, you can check out that discussion on synthetic collars and a lot more. There's a link there, u2.be, lowercase l, lowercase m, 3, lowercase p, capital L, lowercase f, capital K, ZDCC. Okay, so leave that up there for a second. Sam said with the synthetic, I think he's referring to the price can come in the money for more than a total loss of 150. Oh, Todd, you didn't need to say hi, but I appreciate it. Todd also says he's got questions waiting in the wings, too. He's calling from Vancouver as well, so that's great. Let me see. I'm just seeing if there's any other comments here. Okay, good. All right, so now there's a slight add-on here off to the side of the original question from Lance, and the slight add-on is, what did we also just learn? The term parity trade can be slightly misleading. A lot of times, long calls are said to be parity trades of married puts. Not exactly. The risk-reward profile is the same, but a true parity trade to the married put is buying one contract of that long call we saw in Ally for 150, and then taking the remainder $3,850 you would have had and leaving it on hold, not for other trades, not to expose in the market, actually leaving it on hold, so that if the stock falls and you lose 100% of that $150 on the long call, you only lost $150 and you kept $3,850. That is the true parity trade. A long call by itself is not. Falls to the lie of leverage. The married put versus a synthetic married put. Well, that's a little bit closer, I feel. But remember, when you say synthetic, it means you're changing something to get a similar risk reward. It has the potential to end up in a different structure where you could be long stock, long a call, and long a put. Not exactly the same as just the stock and the put combination. Is it better? Well, if the stock goes up, maybe you're double dipping. If the stock falls, maybe not, because you're losing on the long call and the married put in that scenario. Covered call versus naked put. You talk about an in-the-money covered call. I buy a stock at 50, I sell a 47 strike call, and it stays above, I get assigned and make 2%. Rather than do that, I sell the 47 put without owning stock. I put up the margin requirement to buy stock at 47. Stock stays above, put expires worthless, and we have the same 2% yield. Very similar. Stock falls, call expires, you still own stock, but you kept the premium. On naked put, the stock falls, you get assigned to buy stock at the put strike price at 47, and you keep the premium. So they're similar, but they have slightly different outcomes. Credit spreads versus debit spreads. A bull call debit spread with the same strikes and expiration as a bull put credit spread is a parity trade. But now we get into a point where you have to remember although the risk reward is the same, if the stock falls or if it stays above both strike prices or falls below both strike prices, we end up with different obligations. In the bull put credit spread, if the stock falls between the strike, I may end up having to buy shares of stock because the short put's in the money, obligates me to buy just like the naked put. The long option expires worthless if I didn't manage it. On the debit spread, I can sell to close the call for smaller intrinsic value and the short call just expires. I don't have an obligation to do anything in that case. If it's above both, the bull put expires, I have to close out the debit spread to get the profit, extra commissions. Also, I lose a management technique or two, in my opinion, with the debit spreads, depending on what the stock is doing. So although the term parity trade is used, and it is used by me as an options educator, whenever you go to a parity trade, remember, you're changing something about the rights and obligations of the trade to either use less margin, to have lower risk, or in the case of the debit and credit spreads or covered call naked puts, just have potentially a different outcome depending on where the stock is, but the same almost monetary profit, percentage profit as well. But you change something with the rights and obligations of the options, so even though the risk graph looks the same, you may be obligated to do something different in that parity trade by trying to get to a lower leverage and a lower cost. Well, sometimes, as we all know, home repair, car repair, finding the lowest cost may end up having higher prices in the future. That's just one way to look at it. All right, that's for part one. Part two, Lance says, what parameters make good candidates and how can the PowerOptions tools help in the search? What parameters make good candidates? We already showed that on PowerOptions. You go into married put, you go into search, the default search that comes up is the RadioActive screen sorted by earnings per share growth. This is exactly the list that Ernie and I will trade from to post trades for the Fusion subscribers that we're trading in our personal accounts. Okay? We've tested this over years. We go back and test it to make sure it's still performing. And I do the comparisons on a regular basis. Okay? Now I'm going to check the recent results real quick. We'll review it, and then we're going to look at PowerOptions. How can the PowerOptions tools help in the search? By identifying exactly what you want for your risk tolerance and the types of stocks you want as well. Many of you remember this because I have my nice group of friends here that joins me almost every Friday. Recent webinar on May 31st, 2019. Trusting the search results and others on a Friday session. There's the link there for YouTube, but if you just go to PowerOptions YouTube channel and type in Trusting the Search Results, this will come up on the top. What is this? I ran the married put screen, back testing from September 6th. Okay, found positions, stocks that would have matched the RadioActive criteria and the put criteria, okay, of what I would look for in the married put default search. In the 8-month period, the RadioActive stocks that matched it were up 11.1%. I'm not including the puts on this. This is just stock performance. Okay? Now, that doesn't sound too great for an 8-month return. But I want you all to remember something. The market was kind of doing this, and then October, November, December, and then January, February, March, kind of April like that. So there was this huge loss in this time frame from October to November. Okay? So 8-month returns. RadioActive stocks were up, the top 3 RadioActives were up 11.1%. The top 3 NASDAQ stocks that matched criteria, still having to match the put criteria and more with the stock criteria, were only up 1.1%. S&P 5-star rated stocks in that search, using the S&P 5-star list to find the married puts, were those top 3 stocks had an accumulated return of negative 0.7%. Using technicals, looking for MACD and more, it's only up 0.1%. Bollinger Band breakouts, MACD, it didn't give us that oomph. The Dow 30 stocks were down 6.6%, and the value line lists were down 9.7%. The top 3 stocks in that time period were down 9.7%. Now, what about that large jump we saw here from January up to March, roughly? Well, starting on January 2nd, the stocks that matched the RadioActive screens, stock-only return would have been 21.4%. NASDAQs were just up 10.7%, top 3 stocks on the list, sorted by earnings per share growth for all of these. Should have said that before. They're sorted by earnings per share growth. S&P 5-stars were up 3.8%, technicals up 1.4%, Dow 30 up 5%, and value line. And then you see the totals over here. Okay, So that secondary part of your question, what parameters make good candidates, it's the ones we already show. And I do this test almost every year over a 5-month, 6-month, 10-month full year period to see, hey, is there something out there I could have tweaked to make the performance better of the underlying securities? Is there something we need to change in the married put search itself? And if there is, we'll change it based on new market conditions. However, this shows that even in the time period of headline-driven news, the default structure and the default stock settings we're looking for that married put search are performing better than other ideas and other concepts that we could come up with in changing criteria. Okay? Now, I'll pause the screen real quick. Let me just navigate over to Power Options. I went a little bit longer on this discussion than I wanted, but that's perfectly fine. Want to make sure everything is handled. So how can the Power Options search help you? Well, I already mentioned to you that default search is exactly what we look for in a married put. And I'll go to search. And these are the stocks I would select from if I was opening a new position today. Ally Financial is a little bit further down on the list right now, but that's why I used that as an example. It was one of the top ones in the list earlier this afternoon. Scroll down here and take a look. How can the search help you? Whether you want to adjust the maximum risk, the strike range, you want to look further out in time or closer in time. There's a particular stock filter that you like to use that you feel is beneficial. Market cap, you want to look for dividend paying stocks, PE ratios, or technicals is probably a better example. If you feel you want to use RSI, or you want to use Bollinger Bands, MACD crossovers, different moving averages. This tool is set up to help you find specifically what you want in any of the strategies. And on a side note of that, this is not the same criteria I'm going to use for every bullish strategy. When I'm looking at long calls, I want stocks that are performing a little bit stronger and a little bit more volatile. I'm going to look for things maybe such as a Bollinger Band breakout and more. And guess what? That's specifically one of the default searches in the long call screen. In the bull put credit spread search, even though it's a bullish strategy, I want to look for neutral to bullish stocks that have strong measurements. And I'll use the search criteria that's in the bull put weekly default screen. Okay, so they're bullish, they're all bullish strategies, but I'm looking for different criteria. This is our defaults. You ask me what would I use to identify a bull put credit spread, it's going to be one of these top 3 or 4 trades. What criteria would I use to find a diagonal spread? Well, I'd go to calendar call and I'd go to search, and the default that comes up would be my starting point. You don't like those trades or you think they're too risky, that's perfect. You just use the tools here to change anything you want for the underlying stock, structure of the bull put or bear call spread, or anything along those lines to have exactly what you want to see. And of course, if you don't know what to set, that's how Ernie and I help you. But if I open new married puts next week for the Fusion subscribers at RadioActiveTrading.com, it is coming specifically from this list here. To be honest with you, the strong possibility it might be Ally Financial. It's not a recommendation or suggestion, but that's what I'm going to look at next week. Ring Central is another one I'm considering, but it's a little bit high for my blood. My account size. Everything comes down to position sizing and more. Sam does comment. He says he's in a Lulu bull put, and a stock that has sort of a larger gain that might be better for the, for long calls. He says Roku. We looked at that last week on the webinar as well. So that's how the search tools can help you. You structure it based on what you want to see, but we've already shown you what works for us, and I kind of show each year the proof in the pudding of why I'm doing that specific search and why I don't think it's better to change from, let's say, to NASDAQ stocks or to S&P 500 stocks. Using this criteria performs best, and having the structure of that risk threshold and not going too deep in the money or too deep out of the money based on the best structure of the married put, that's what we're showing. Okay, so that's what parameters make good candidates for this strategy and how the Power Options tools can help you in the search as well. We'll come back to that in a moment for John's question a little bit later on. But right now, what we have to do, of course, is that wraps up what I have for Lance as far as his questions go.